Assalamualaikum and have a good day, Miss Akila. So today, our group, which is Group N, we will present the demonstrating calculation. So we will start with the question 1. So as you can see on this note, I already collect all the data from the question given. So the first information that I got is for the system A. The IO is for 40,000 ringgit, Pratex 20,000 ringgit, lifetime 4 years. And the system B, the IO is 1600,000 ringgit, Pratex 10,000 ringgit, lifetime 6 years. And the tax rate is 30%, discount rate 16%, and depreciation 100,000. So next, this is the answer. So I already calculate for the OCF in the system A. So for the formula, OCF is negative minus EBIT multiply 1 minus tax rate plus depreciation multiply tax rate. Then negative 20,000 multiply 1 minus 0.30 plus 100,000 multiply 0.30. Next, minus 20,000 multiply 0.70 plus 30,000. So the answer is 191,600 for the OCF system A. Next, we will calculate for the PV for the system A. So the formula for PV is OCF plus PVIFA minus IO. So 16,000 multiply 2.0982 minus 40,000. So the answer is negative 35522x point x. Okay, so next we will calculate the ESC. So for the formula, ESC is total LPV divide PVIFA. So next, 355,228.8 divide 2.7982 is negative 129,269.04. Okay, so next we will calculate for the OCF in the system B. So for the formula, OCF is negative EBIT multiply 1 minus tax rate plus depreciations multiply tax rate. So negative 10,000 multiply 1 minus 0.30 plus 100,000 multiply 0.30. So negative 7,000 plus 30,000. So the answer is 23000. So next, we will calculate for the PV for the system B. So the formula for PV is OCF multiply PVIFA minus IO. So 23,000 multiply 3.6847 minus 40,000. So the answer is minus 315,251.9. Next, we will calculate for the ESC. So the formula for ESC is total MPV divide PVIFA. So negative 3.5251.9 divide 3.6847. So the answer is 85557.01. For this question, system B should be selected because it has a lower ESC, and this is making the most cost-effective option in the long run. So in conclusion, the calculation highlight the importance of minimizing cost while maximizing returns, a critical aspect of corporate financial strategy. For example, Amazon investment in automated warehouse reflect a similar cost-benefit analysis to optimize operational efficiency and long-term profitability while managing risk.
Question 1B, to calculate OCF and NPV. The case study is the Toyota's investment in a hybrid car manufacturing line. Toyota Motor Corporation considers setting up a new hybrid car production line in Malaysia to meet growing demand in Southeast Asia. The initial investment is 900,000 ringgit, evaluated over a 5-year horizon using straight line depreciation. The selling price per unit equals 30 ringgit, the VC per unit equals 10 ringgit, and the fixed cost equals 200,000 ringgit. To calculate operating cash flow, OCF, the formula is OCF equal to EBIT multiplied by 1 minus tax rate plus depreciation. Next, calculate the EBIT step by step. First, revenue equals selling price multiplied by unit sold, which is revenue equals to 30 ringgit multiplied by 10,000 equals 300,000 ringgit. Next, VC equals VC per unit multiplied by unit sold, which is VC equals to 10 ringgit multiplied by 10,000 equal 100,000 ringgit. Next, EBIT equals revenue minus VC minus FC and minus depreciation, which is EBIT equals to 300,000 minus 100,000 minus 200,000 minus 180,000. EBIT equals negative 180,000 ringgit. After calculating EBIT, substitute it into the OCF formula since the tax rate is 0, because the EBIT is in the negative. OCF equals to 0 ringgit. Number 2, to calculate the OCF and NPV for 12,000 units. The EBIT is recalculated step by step. First, revenue equals selling price multiplied by units sold, which is revenue equals to 30 ringgit multiplied by 12,000 equals 360,000 ringgit. Next, VC equals VC per unit multiplied by unit sold, which is VC equals to 10 ringgit multiplied by 12,000 equals 120,000 ringgit. EBIT equals revenue minus VC minus FC minus depreciation, which is EBIT equals to 360,000 minus 120,000 minus 200,000 minus 180,000. Next, EBIT equals negative 140,000 ringgit. OCF equals to negative 140,000 multiplied by 1 minus 0.35 plus 180,000. OCF equals to negative 91,000 plus 180,000 equals 89,000 ringgit. Finally, calculate NPV using the formula. NPV equals to OCF multiplied by PVIFA minus initial investment IO. The PVIFA for 5 years at 12% equals 3.7908. From the table, substituting the values, NPV equals to 89,000 multiplied by 3.7908 minus 900,000. NPV equals to negative 562,618.8 ringgit. Since the NPV is negative, the project is not financially viable.
Zahora Berhad is an unlevered firm. Unlevered firm, the cost of equity equals to WACC, weighted average cost of capital, which is 12%. Because the firm is unlevered means there has no debt. The WACC, which is weighted average cost of capital, is the average cost of all the capital sources. But since there is only equity, the WACC equals to the cost of equity. Therefore, the cost of equity before restructuring is 12%. Before restructuring is 12%. So for the cost of equity after restructuring, the formula is cost of equity for unlevered firm plus with cost of equity for unlevered firm minus cost of debt, then times with debt to equity ratio times 1 minus tax. Now the percentage is, the formula is RE equals to RO plus RO minus RD times D divide E times 1 minus tax, which RO is cost of equity after restructuring, RD is cost of debt, R divide E is debt to equity ratio, and tax is corporate tax rate. So 12% plus 2% times 40 over 60 times 1 minus 30% equals to, the RE will get 12.93 percentage, which is 12.94. So here I show you the calculation, how to calculate using calculator, financial calculator. So this is the way how to calculate using calculator. So for the WCC after restructuring is E divide V times cost of equity after restructuring plus D over V times cost of debt times 1 minus tax rate. So 60 over 100 times 12.93 percentage plus 40 over 100 times 10% and 1 minus 30 percentage. So the WACC after restructuring is 10.56 percentage. So here is the way how to calculate using calculator. So for 2D net present value, to calculate the net present value of the proposed project is, the project after tax cash flow equals to 750,000 RM. Discount rate is WACC equals to 10.56 percentage, just now we get. So the NPV equals to negative initial investment plus annual cash flow divide discount rate. So the NPV equals to negative 2 million plus 750,000 divide 10.56 percentage. So the NPV equals to negative 2 million plus 750,000 divide 10.56 percentage, will get 5,102,272.73 cent. For question 2E, determine the value of the firm without debt. So expected free cash flow is 750,000. Cost of equity before restructuring is 12%. So what value of the firm without debt equals to expected free cash flow divide cost of equity before restructuring equals to 12%. 750,000 divide 12% will get 6,000. Okay, 750,000 divide 12%. Okay, we'll get 6,250,000. Question 6. Zahora Berhad is an unlevered firm. Unlevered firm. The cost of equity equals to WACC, weighted average cost of capital, which is 12%, because the firm is unlevered, means there has no debt. The WACC, which is weighted average cost of capital, is the average cost of all the capital sources. But since there is only equity, the WACC equals to the cost of equity. Therefore, the cost of equity before restructuring is 12%. Before restructuring is 12%. So for the cost of equity after restructuring, The formula is cost of equity for unlevered firm plus with cost of equity for unlevered firm minus cost of debt, then times with debt to equity ratio times 1 minus tax. Now the percentage is, the formula is RE equals to RO plus RO minus RD times D divide E times 1 minus tax, which RO is cost of equity after restructuring, RD is cost of debt, R divide E is debt to equity ratio, and tax is corporate tax rate. So 12% plus 2% times 40 over 60 times 1 minus 30% equals to, the RE will get 12.93 percentage, which is 12.94. So here I show you the calculation, how to calculate using calculator, financial calculator. So this is the way how to calculate using calculator. So for the WACC after restructuring is E divide V times cost of equity after restructuring plus D over V times cost of debt times 1 minus tax rate. So 60 over 100 times 12.93 percentage plus 40 over 100 times 10% and 1 minus 30 percentage. So the WACC after restructuring is 10.56 percentage. So here is the way how to calculate using calculator. So for 2D net present value, to calculate the net present value of the proposed project is the project after tax cash flow equals to 750,000 RM. Discount rate is WACC equals to 10.56 percentage, just now we get. So the NPV equals to negative initial investment plus annual cash flow divide discount rate. So the NPV equals to negative 2 million plus 750,000 divide 10.56 percentage. So the NPV equals to negative 2 million plus 750,000 divide 10.56 percentage will get 5,102,272.73 cent. For question 2E, determine the value of the firm without debt. So expected free cash flow is 750,000. Cost of equity before restructuring is 12%. So what value of the firm without debt equals to expected free cash flow divide cost of equity before restructuring equals to 12%. 750,000 divide 12% will get 6,000. Okay, 750,000 divide 12%. Okay, we'll get 6,250,000. Question 6.
Good day everyone. Today I will be demonstrating of the question 3 for the corporate finance. Question 3. Okay, if the target capital structure of Nuha Berhad is 1.5 and the WACC is 10% and the tax rate is 30%. So determine the cost of equity capital if the after-tax cost of debt is 7%. Okay, now let's find it. So based on information, capital structure equal to 1.5 is equal to 1.5. You know, the WACC is equal to 10%, and for the tax rate is equal to 30%, and also So right now, okay, we need to find the cost of equity capital, which is the RE. So RE we don't know, but we do know that the after cost of debt after tax is 7%. Okay, after tax cost of debt is equal to 7%. Okay, so we'll be using the WACC formula. E plus D over V times by RD times by RD, then times by 1 minus C. Right. So let's find our answer based on using the formula given. So we have 10% equal to 1 over plus 1.5 RE. So right now we don't know what is the cost of capital, so we just put RE instead, plus 1.5 over 1 plus 1.5 times by 0.1 times by bracket 1 minus 0.3, which is the 30% of it. So we change it to a proper way, 0.1 1 over 2.5 times by RE .5 times by 0.07. Okay, 1.0. Right. So we get based on the calculator. So what we need to find based on the question is about B1, WACC, weighted average cost of capital. 2, the weighted average fluctuation cost. 3, the true cost of fund needed. So we need to find what the missing pieces of the information. Basically, we don't have all the information for RD and RE. So we need to find this missing information. So we will begin to find the solution. Okay, moving on to question 3B. 3B is about the Amani Foundation. So based on the question, Amani is looking for a fund of 8 million through issuance of bonds, preferred stocks, and common stocks. And based on the information available, the 2 million bonds is the debt. Meanwhile, the 2.5 million is the preferred stock, and the 3.5 million common stock is referring to the equity. Okay, now the information below also stated that there's some information below which I already extracted it. Okay, based on the first information about bonds, so regarding about bonds, there's a coupon rate of 0.09, maturity life for 10 years, fluctuation cost 7%, market price is 1,200, and the second fund, this is referring to the stock. The stock price is 100, dividend DO is 8 ringgit 50 cent, fluctuation cost is 3%, And the third fund, which is the common stock, dividend is 3 ringgit. Frustration cost is 4%. Dividend growth, G, is stated that there's a 5% of the dividend growth is 5% constant. And the last thing is the market price of the stock is equal to 16 ringgit. So basically, I already extract all the information and already label all the necessary information. Okay, right now, what we need to find is, oh yeah, don't forget that there's a 30% rate. The company pays corporate tax of 30%. So right now, what we need to find is the RD. Okay, good evening everyone. Let's move on to the question 383. So given the WACC of Nuha Berhad is 9.96%, the cost of equity and the before tax of cost of debt are 18% and 9% respectively. Determine the target debt to equity ratio assuming the tax rate is 34%. Okay, so already pull off the information. The WACC is 9.96%. I covered it already. The RE is 18%. RD is 9%. So let's find out the and the tax rate is 34%. The tax rate I highlighted is assuming, because based on the question mentioned that assuming the tax rate is 34%. Now we use the WACC formula. Okay, 0.90996 bracket 1 over 1 plus D over E, because we don't know based on the question it did not provide the info, so we just put it like that, times by 0.18 bracket plus D over E divided over equity, debt over equity 1 plus D over E times by 0.09 times by 1 minus 0.34 0.0996 equal to 0.18 plus 0.05994 times by D over E over 1 plus D over E. Okay, 0.0996 plus 0.0996 times by D over E. D over E equal to 0.18 plus 0.0594 D over E. Okay. Zero point 0.0996 D over E minus by 0.0594 D over E equal to 0.18 minus minus by 0.0996 so we minus 0.996 DE minus by 0.0594 DE, so we get roughly about 0.0402 DE equal to 0.18 minus by 0.09996. So we get roughly about 0.0804, and this number we just bring over minus, so we're left by D over E equal to 0.084, sorry, 0.0804 minus by 0.0402 will be equal to 0.0402, and then after that, okay everyone, we move on to the question 3 3A2. So basically 3A2 is to calculate before tax cost of debt capital if the cost of equity RE is 20%. So basically we have the RE 20%, but we don't know what's the RD. So by using the WACC formula, we use the WACC formula, so just put it on, insert 0.1. We just use all the information based on the previous question. Bracket 1 over 2.5 times by 0.20 plus bracket 1.5 over 2.5 times by RD, since we don't know what's RD, times by 1 minus 0.3. Okay, this will be equal to 0.08 plus 0.2 times by RD times by RD times by RD, and after that we will move the RD to here. So I will write down more properly, 0.42 times by RD equal to 0.1 minus 0.08. We will get 0.02. Bring over the 0.42, which is divided, which we do 42. So our final answer will be 0.0476 or 4.76%. So that will be our RD, which is the cost of debt. Alright, continue. Okay, after we calculate, we get a 0.4 times by RE plus 0.042. Okay, we just move over the 0.4 times by RE equal to 0.1 minus 0.042. Okay, now just make it simple like this. RE, we just bring over here, which is just multiple 0.058. Bring over the 0.4, so we will get about okay, the answer for that question will be 0.145, or the real so if we multiply by 100, it should be 14.5%. So the cost of equity so noise RE is equal to 14.5%. Next, we'll find the RE. Okay, about the dividend. Okay, go to D1 minus P0 plus G. Right, what do we get here? So based on formula, we do a bracket again 1 plus G over PO plus G, then equal to, just insert whatever information based on the bonds, preferred stocks or common stocks. So we just based on for this to find RE, we just based on the information based on about the common stocks. Okay, because we need to find the growth dividend. Okay, RM 3 ringgit, bracket 1 plus 0.05 bracket, for the market price, PO, it will be 16 ringgit. 16 ringgit plus 0.05, which is the growth. Okay, to get this, we roughly get about 0.2469. Yeah, we will get up, it will be equal to 0.2469, or we change it to percentage, we will get roughly about 24.69%. And let's not forget, let's find the RP. I forgot to mention before this, we need to find RP. Okay, RP equal to D over P. So what will we get? Okay, this one based on the preferred stock for information, we'll extract from it. D, which is the dividend, which is equal to 8 ringgit 50 cent over 100. So we get roughly about 0.085. Or change it to percentage, we will get about 8.5%. Okay, now we move on to the 3B2 to calculate the weighted average flotation cost, or also known as WAFC. So this is information. This is the formula. Okay. So based on the question, it has to calculate about flotation cost. So we'll take the available information. So equity was 3.5 million. 8 million times by fluctuation cost for the equity was 0.04 bracket plus debt was 2 million over value was 8 million times by fluctuation debt was 0.07 bracket plus for the value was 2.5 million, 8 million over 8 million, sorry, 1 2 3 1 2 1 2 3 1 2 3, okay, time by fluctuation for preferred stock. Preferred stock was 0.03 bracket. Okay, bracket. After that, we will get roughly about 1.7 plus 1.7 plus 0.94. Then the total answer for this, after adding all up of this, you will get about 4.4%. Okay, let's move on for the part of the question B1 to calculate the WACC. Okay, let's calculate the WACC based on the formula which already stated it, written it. So we just insert all the available information. So equity will be 3.5 million, while the value is 8 million times by RE. Our RE was 0.02469 bracket plus, sorry for the bracket, plus the debt 2 million over V8 million times by RD. Our RD was, let's take it from the after tax, which is 0.45 bracket plus P preferred stock 2.5 million and over P is over V 8 million times by RP RP, sorry, 0.085. So after calculating it, you get 1.08 plus, sorry, we get 1.08 plus 1.13 plus 2.66 equal to, you will get roughly about 1.08 plus 1.13 plus 2.66, 4.87%. Now we move on to the second, which is the 3B2. So 3B2. Now we will calculate for the last 3B, which is the true cost of the fund needed. The true cost of the fund needed. So the formula for this one will be project cost over 1 minus WAFC, which is from this one, from our answer. So okay, project cost was roughly about 8 million over 1. We try to convert this 1.44% into a normal number, which will be 0.0444. Okay. Now 8 million over 0.956, we will get roughly about the true actual cost will be 8 million 1 2 3 1 2 1 2 3 1 2 3 minus by 0.9556. You get this answer. So basically it will be 8371 7031642. So this is the true cost of the project. So let's find the first misinformation. RD equal to CP plus PV minus MP. We use this formula to find our RD because we don't know what is the RD. Over plus MP over 2. So basically equal to 0.09. Let's not forget about bracket. Divided by 1000 plus 1000 minus by 1200 bracket 10 after that 1000 plus 1200 over 2 bracket. Okay, after that we need to find the RD, the depth. RD, this one is before tax. So before tax is like, so based on question, you will get 70 over 1100, and that will be 70 over 1100. You will get 0.06363 and 63. Okay, so that's our RD before tax, but we need to find our RD also, which is the after tax. After tax. So basically 0.06363 times by 1 minus 0.3, you will get about 0.0445, or converted into percentage, you will get 4.45%. So this is our RD for the after tax.
Next, we are going to continue with the question 4. So from the above, you can see this is the information that I got from the question. So the first information that I got is for the IO is 40,000 ringgit. Lifetimes 8 years, discount rate 12%, tax rate 28%, quantity 125 units, the price 10,000 ringgit, variable 8,000 ringgit, fixed cost 65,000 ringgit. For your information, for this question, you need to do a table when this question is come out during on final exam. This is the first thing you need to do is do a table. So what need on the table? So on the above side, you need to write the worst case, best case, and best case. Meanwhile, the left side, you need to write the quantity, price, VC, which is variable cost, fixed cost, OCF, and NPV. So for the best case, you just the value you can get from the question, exclude for the SCF and NPV that you need to calculate on by your own. So for the best case, for the quantity is 1 to 5, and the price is 10,000 ringgit, and the variable cost is 8,000 ringgit, and the fixed cost is 65,000 ringgit. So the first thing that we need to do is we need to calculate the answer with the right formula to fill on that table. So let's start it. So for the first thing that we need to calculate for this question is quantity for the worst case. So for the worst case, I calculate with the 1 to 5 minus 10%, and the answer is 112.5. Next, we are going to calculate for the price is 10,000 minus 10%, which is the answer is 9,000 ringgit. Next, for the variable cost, the answer is 7,200 with the formula 8,000 minus 10%, and the fixed cost is 65,000 minus 10%, and the answer is 58,500. So we going to fill on that table the answer. So for the quantity, we got 112.5, and the price is 9,000 ringgit, and the variable cost 7,200, the fixed cost 58,500. Okay, next we are going to calculate the quantity for the best case. So the next we 1 to 5 plus 10%, we got 137.5. For the price, we got 11,000 ringgit with the formula 10,000 plus 10%, and variable cost 8,000 plus 10%, we got 8,800. And lastly is we calculate for the fixed cost, which is 65,000 plus 6,500,000 plus 10%, we got 71,500. So we need to fill on that table. So we got for the price is 130.5. Next, for the price is 11,000. Next, for the variable cost, we got 8,800. And for the fixed cost, we got 71,500. Okay, next we are going to calculate for the OCF and NPV for the best scenario. So the formula for OCF is P minus VC multiply quantity minus FC multiply want minus tax rate plus depreciation multiply tax rate. So 10%, 10,000 minus 8,000 multiply 1 to 5 minus 65,000 plus 100,000 multiply 1.28. So the answer is 147,200. Next, we calculate for the NPV, which is for the formula NPV is OCF minus OCF multiply PVIFA minus IO. So 147,200 multiply 4.9676 minus 100,000. So the answer is 331,230.72. So the answer we need to fill on the table for the OCF and NPV. So the for OCF we got 147,200, and the NPV we got 230.72. Okay, let's move. We are going to do the best scenario for the OCF. So the formula for OCF is P minus VC multiply quantity minus FC multiply want minus tax rate plus depreciation multiply tax rate. So 11,000 minus 0,000 is 7,200 multiply 137.5 minus 58,500 multiply 1 minus 0.28 plus 5,000 multiply 0.28. So the answer for the OCF is 348,080. And the next is NPV is OCF multiply PVIFA minus IO. So 348,080 multiply 4.9676 minus 100,000. So the answer is 132,922.208. So we need to fill on that table the answer. So for the best case OCF is for the OCF 348,080. For the NPV 1329 122.208. Next, we move to calculate for the worst case for the OCF. So, for the OCF, the formula is P minus VC multiply Q minus FC multiply 1 minus tax rate plus depreciation multiply tax rate. So, 9,000 minus 8,800 multiply 112.5 minus 71,500 multiply 1 minus 0.28 plus 50,000 multiply 0.28. So the answer for this OCF is negative 212.80. Next, we move to calculate for the NPV. So the formula for NPV is OCF multiply PVIFA minus IO. So minus 21280 multiply 4.9676 minus 100,000. So the answer for this is 505 705 710.53. This is negative. So we need to fill on that table for the answer. 2 1 2 8 0 5 or 505 710.53. Okay, complete for the question 1. Next, we move to question 2. Okay, what is the sensitivity of the base NPV to change in unit price? So, for this question, we need to calculate for the OCF, which is for formula for OCF is P minus VC multiply Q minus FC multiply 1 minus tax rate plus depreciation multiply tax rate. So 10,000 minus 8,000 multiply 1 to 5 minus 65,000 multiply 1 minus 0.28 plus 50,000 multiply 1.28. So the answer is 14720. For the assumption price for this is 12,000. So OCF is for the OCF is 12,000 minus 8,000 multiply 1 to 5 minus 65,000 multiply 1 to minus 0.28 plus 50,000 multiply 0.28. So the answer for this is 3,207 200. Next, we move to the sensitivity. So for the sensitivity, the calculation is 327 200 minus 147 200 divide 12,000 minus 50,000. We got 18,180,000 divide 2,000. So the answer is 90. Next, we move to the question 3, which is accounting break-even level output of this project. For the formula accounting break-even is fixed cost plus depreciation minus divide price minus variable cost. So 65,000 plus 50,000 divide 10,000 minus 8,000. So the answer is 57.5. Next, we move to calculate for degree of leverage of the accounting break-even level. So for the formula, degree of leverage is 1 plus fixed cost minus degree of leverage. So we got 1 plus 65,000 divide 100,000. So the answer is 2.3%. Next, we move the next question, which is 1B. Discuss the stand-alone principle in project evaluation. So the answer is the stand-alone principle in project evaluation is the idea that can generate cash flow from a project independently from the company. Basically, the stand-alone in project has own revenue expense and investment requirement. In other words, the project cash flow and performance are analyzed independently without considering the financial interaction. In conclusion, this calculation helps corporations prioritize investment that align with strategic goals such as Amazonization to expand cloud service based on the project MPVs while managing risks like market competition and fluctuating demands.
Question number 5, which is part A, is the definition of synergy. Synergy refers to the combined value and performance of two companies being greater than the sum of their individual values. Synergy is often the goal of mergers and acquisition, achieved through cost savings, increased market share, or enhanced operational efficiencies. Part B is defensive tactics. First, the corporate charter. The corporate charter outlines the rules and regulations that govern a company's operations. As a defensive tactic, companies can amend their charters to include provisions that make hostile takeovers difficult, such as requiring supermajority approval for mergers or acquisitions. Second, golden parachute. Golden parachutes are large financial compensation package offered to top executives if they lost their position due to the takeover. This package can deter acquirers by increasing the cost of a merger. The last but not least, White Knight. A White Knight is a friendly company that steps into the acquire a target company facing a hostile takeover. The White Knight offers better terms and alliance with the target market's management and interest. Value of Belaisa Berhad to Sarai Corporation. The current market value of Belaisa Berhad is calculated by multiplying its outstanding shares, which is 20,000, by the price per share, which is 17 ringgit and 50 cents. Thus, 20,000 multiplied by 17 ringgit and 50 cents is equal to 350,000 ringgit. Adding the economic gain, which is 100,000 ringgit, the total value of Belaisa Berhad to Sarai Corporation is 350,000 plus 100,000 is equal to 450,000 ringgit. Next, the acquisition cost of Belaisa Berhad is calculated by multiplying its outstanding shares, which is 20,000, by the acquisition price per share, which is 20 ringgit. Thus, 20,000 multiplied by 20 ringgit is equal to 400,000 ringgit. Next, the NPV can be determined by subtracting the acquisition cost from the value of Balai Saberhad to Serai Corporation. 450,000 minus 400,000 is equal to 50,000 ringgit. Therefore, the NPV is 50,000 ringgit. Third question is the price of Serai's share after the acquisition. The new market value of Serai Corporation after the acquisition
Higher profitability index and IRR, internal rate of return, above the cost of capital. So, what give the best project? Okay, now I will explain about the implication of calculation. So first, I would like to explain about the payback period. This is question 6. So for payback period, the Wagyu's payback period is 3.2 years. It's indicating the project recovers its initial investment faster than Famous, which has payback period of 3.74 years. So the implication for this payback period is shorter payback periods reduce liquidity risk of constrained cash flows. However, the payback period ignores the time value of money and cash flows beyond the payback point. So the startups often prioritize projects with shorter payback period to quickly reinvest in growth. For instance, during its early stages, Uber company focused on projects with rapid returns to sustain its aggressive expansion. Question 6. It's about Halton Group is considering one of the two mutually exclusive projects, Walk and Famous. The after-tax cash flow for the projects are as follow. Exclusive projects, Walk, Famous. The after-tax flows for the projects as follow. Okay, year 0, 1, 2, 3, 4, 5, 6, Walk, RM, Famous, also in Malaysia. So, okay, negative 160,000 for year 1, 50,000 until year 5, 50,000. For year 6, there is no amount. So, same goes to Famous, negative 220,000, and until need to put year 6 is 30,000. So assuming the cost of capital is 12%, so you are required to calculate payback period, net present value, profitability index, and internal rate of return for both projects. So now let's calculate for payback period for Wagyu. So for the year 1, we'll get 50,000. For the year 2, 50,000. So the cumulative is 100,000. 50 plus 50,000. For the year 3, 50,000. So the cumulative will be 150,000. For the year 4, 10,000 needed to recover balance, RM 10,000 from 50,000. Then payback period for Famous is year 1, 25,000. For year 2, 35,000. The cumulative will be 60,000. For the year 3, 60,000. So the cumulative will be 120,000. For year 4, 40,000 needed to recover balance RM 40,000 from 54,000. So the payback period is 3 plus 40,000 divided 54,000 equals to 3.74 years. And yeah, the payback period for Wagyu is 3 plus 10,000 divided 50,000 equals to 3.2 years. Okay, for the net present value, need to calculate cash flow, divide 1 plus R minus initial investment. So for the WACC, we will calculate according negative 160,000 plus 50,000 divide 1.12 for year 1 until year 5. So after plus all the thing, NPV will get 20,235, and for MS same also. So the NPV will get RM negative 55,991. For the profitability index, PV of future cash flow divided by initial investment. So for the Wagyu, 180,235 divided by 160,000 will get 113, and for the MS 164,009 divided 220,000 will get 0.75. Okay, now internal rate of return. So we will calculate where NPV equals to 0. For the Wagyu, where R is 12%, the NPV more than 0, and the IRR is greater than 12%. When R is 15%, the NPV more than 0, so the IRR is still greater than 15%. When R is 16.5%, the NPV more than 0, so the IRR is still slightly greater than 16.5%. Where R is 17%, the NPV is negative 49. So IRR for Wagyu is 16.9%. For Famous, when R is 12%, the NPV less than 0, so the IRR is less than 12%. When R is 10%, the NPV less than 0, IRR is still less than 10%. When R is 8%, the NPV less than 0, IRR is still less than 8%. When R is 5%, the NPV is negative 7,253. When R is 4.5%, the NPV is negative 5169. So IRR for Famous is 4.5. The decision is Wagyu has shorter payback period, higher and okay. Now I will explain about the implication of calculation. So first I would like to explain about the payback period. This is question 6. So for payback period, the Wagyu's payback period is 3.2 years. It's indicating the project recovers its initial investment faster than Famous, which has payback period of 3.74 years. So the implication for this payback period is shorter payback periods reduce liquidity risk for swing cash flows. However, the payback period ignores the time value of money and cash flows beyond the payback point. So the startups often prioritize projects with shorter payback period to quickly reinvest in growth. For instance, during its early stages, Uber company focused on projects with rapid returns to sustain its aggressive expansion. When it comes to net present value, Wagyu net present value is 20 RM 20,253, indicating a positive value added to the firm. Famous NPV, which is net present value, is RM negative 55,117, which is a negative value suggesting the project destroys value. So the implication we can discuss in net present value is positive net present value projects align with shareholder wealth maximization and should be accepted. Wagyu's higher NPV makes it the superior choice. For example, when Apple company launched the iPhone product line, detailed NPV analysis justified the investment due to its projection long-term cash flow benefits. Now, when come to profitability index, Wagyu profitability index is 1.13. It means the project generates RM 1 ringgit 13 cent for every 1 ringgit invested. When it comes to Famous, the profitability index is 0.75, which is, it means the project generates less than 1 ringgit for every 1 ringgit invested. It's making it an unviable option. So the implication we can discuss it. Projects with profitability index lower than 1 indicate value creation. Wagyu's higher profitability index reinforces its selection of Famous. The example we can give, like Amazon company evaluates warehouse automation projects using profitability index to ensure investments yield return above their capital cost. Okay, when it comes to interest rate of return, which is IRR, for the Wagyu, the IRR is 16.9%, higher than the cost of capital, which is 12%, and making it an attractive investment. For Famous, is the IRR is 4.5%, while it's below the cost of capital, it's indicating a poor investment. So the implication we can conclude for this IRR is IRR help compare projects with different cash flow patterns and identify value creating investments. Like Tesla's renewable energy projects often have IRR exceeding 20%, so it's reflecting their long-term viability and alignment with the firm's sustainable goals. So the theoretical and practical application is capital budgeting principle. When it comes to capital budgeting principle, the NPV, the PI, IRR calculations align with the capital budgeting principle, where NPV is the most reliable metric as it directly measures the value creation. So the payback period, while useful for assessing risk, should not be the sole decision criterion due to its limitation, like ignoring cash flow after the payback period. So the second point we can says about the theoretical and practical application is mutually exclusive projects. The higher NPV, which is Wagyu, should be chosen because as it's contribute the most to shareholder wealth for mutually exclusive projects. For an example, most of the oil companies often face mutually exclusive investment decisions between exploring new field or upgrading existing refineries using similar metrics to evaluate projects. Okay, when it comes to the third point is risk management. The negative NPV and low IRR of Famous highlight the importance of risk management and avoiding projects that drain resources. For an example, like Boeing's decision to halt certain aircraft models was based on similar financial analysis, avoiding further losses. So the final point we can discuss is strategic financial planning. So, Wagyu's results suggest aligning investment with the firm's cost of capital and focus on high return opportunities to maintain competitiveness. So the conclusion we can give is the analysis demonstrate that Wagyu is better investment option due to its shorter payback period, positive NPV, PI lower than 1 and higher IRR. So these insights emphasize the importance of comprehensive capital budgeting in corporate financial strategy, and it highlights the theoretical principle practical value in real world decision making. Thank you.
Okay, now we move on to the example for the summarizing. First, in terms of the first factor of corporate financial strategy. So, if the cost capital is low, so machine Q will have a better chance in terms of higher return over time, while for machine P, if it has a cost capital of have a high cost of capital, machine P will be more attractive because it has a lower initial investment, and this corporate financial strategy is a very critical tool in evaluating funding in capital allocation in allocation strategy. For example, let's take an example like General Electric. We all know that General Electric is one of the biggest company that make aviation engine production. So they often use such analysis to decide between capital intensive and less capital intensive project depending on market condition. And moving on to the second point, which is the investment decision. So basically, the crossover rate directly impacts the project selection by determining which machine aligns with the company financial goals and market condition. So for basically in terms of risk and return balance, machine Q provide a better cash inflows but require a higher upfront investment, making it more suitable for a company seeking a higher return and willing to take on more risk. Meanwhile, for machine P has lower inflows, but they require a small amount of upfront investment, which is ideal for risk averse strategy or tight cash flow. In terms of example, we can take like for Boeing Aviation Company, they adopt this kind of similar approach or similar analysis to decide whether to develop a high capital project like building a new aircraft or just by modifying or upgrading the existing models that they have now. Meanwhile, for the risk management, well, there are two scenarios. First is they need to deal with the mitigating financial risks. For example, like Nestle, they often consider fluctuating interest rates and inflation risks when evaluating projects with different upfront costs and returns. And also they need to take account in scenario planning, where a company can prepare for different scenarios by stress testing the cost of capital and projecting how the project would perform if the rates exceed or fall below the crossover rate. And for example, the case study example we can take like from the Amazon Capital Investment, where they frequently evaluate whether to invest in new warehouse or infrastructure based on their capital costs. And for oil and gas, let's take like example like ExxonMobil firm. They use crossover analysis to choose between high investment projects such as offshore drilling and lower cost, lower return alternative like onshore drilling. So that is it. Thank you.